Hello, accounting superstars. Welcome to the Accounting Superstar channel. I'm so glad you're here. This is the place to learn accounting. I'm Professor Don Bush, and I've been teaching accounting for about 30 years and been a CPA for about that long, and I've got lots of great ways to explain accounting. What we've been doing is we've been working on this spreadsheet, and it's a worksheet to help us determine the journal entries necessary for pensions. It's a pretty cool spreadsheet, and it's not that hard to use once you understand it. This is the second example. In the first example, we just did the very basics, and you might want to go back and watch that first example. So example 2 is a continuation of example 1. For instance, the balance January 1st, 2002, where did we get these numbers? Well, these were the ending balances from example 1. So this example just carries over. So here's how this spreadsheet works. On the left-hand side, we've got the things that happened relating to the pension fund. In the middle, we've got all the information that we need to make a journal entry, and the journal entry is right down here along the bottom. And over here in the green, this represents the trust company that is monitoring and taking care of the pension and making sure that the pension benefits are being dispersed to retired workers. So here we go. So the balance January 1st, 2002. Let's go over here to the green area, the memo record. So pension assets, $12,000. Now this is not on our books. This is on the trust fund, the people that are watching the pension for us. So $12,000 debit. The projected pension liability, which is the present value of the pension obligation here, is $11,000. And so the difference between these two, if you take the $12,000 debit minus away the $11,000 credit, you would get a $1,000 debit. And that is why this is a $1,000 debit. It simply represents what's going on over here in the pension fund. So first thing, employee service cost, $4,000 debit. Our employees worked and earned pension benefits during the year, and we will credit $4,000 here under the projected pension liability. Employer contributions to plan. Well, the company sent in $3,000 to the pension fund, so we have $3,000 credit and a $3,000 debit, and it's important to make sure that these lines add up horizontally, that debits equal credits horizontally. Now that's not true in this first line right here, but it's true in the other lines. Letter C, interest cost, $550. Where'd that come from? Well, it's 5% of the beginning liability. So here's the beginning liability right here, $11,000. If you take $11,000 times 5%, you get $550. So why are we doing this, and why 5%? Well, I just chose 5% as the interest rate. Of course, it may vary in real life here, but in this example, we're just using 5%. But here's why we're doing it, is that whenever you have a present value and a liability and future obligations, there's always an interest component. And so this $11,000 is listed at the present value, not at the future value, but the present value. So we, as time goes by, we need to incorporate interest into this. So all we're doing is taking 11,000 times 5%, which equals $550. So $550 debit to pension expense. The projected liability is being increased by $550 credit. So horizontally, it balances out. The actual return on pension assets. Well, the pension had a good year. They made some money. They made some good investments, maybe earned interest and dividends. So what we're doing is we're putting it under pension expense, $800, but we're putting it as a credit, not a debit. It's a credit. So why is it a credit? Because, well, it's a credit because when the pension fund earns money on the investment, that lessens the burden on the company. So we're crediting pension expense for $800. It'll, in essence, reduce the pension expense by $800. And over here under pension assets, well, the pension assets grew by $800. So $800 debit. And again, we balance horizontally. Now coming down to letter E, benefits paid to workers. Well, workers were paid this year. Now, we're not crediting cash at all, but it's coming out of the pension fund. So it's all taking place over here on the right-hand side. So pension assets were used up to pay this, to pay our workers. And so we're crediting pension assets for $2,500. And we're debiting the projected pension liability for $2,500 because the liability is being decreased. The company is fulfilling its obligation by paying these pension benefits. So those were all the transactions that happened during the year. So now our job is to formulate a journal entry. So what we do is we total up these columns in blue. So pension expense, we've got a $4,000 debit, $550 debit, so we'll add those two together. We have an $800 credit, so we need to subtract that. So 4,000 plus 550 minus 800 is 3,750. So our pension expense will be 3,750. Let's add up the cash column, which is easy. $3,000 credit, so the total here is $3,000 credit. Now, the 750, how do we do that? There's nothing in this column here. Well, we don't need to use that column. So what we're doing is we just look at the $3,750 debit and the $3,000 credit. And we ask ourselves, what's it going to take to make this thing balance? Well, to make it balance, we need a $750 credit because $750 credit plus a $3,000 credit is equal to a $3,750 debit. So it all balances out. That's how you figure it out. Now coming down to the end of year balances, and when we do example number 3, these end of year balances will become the beginning balances for example 3. But for now, they're the ending balances. So how do we figure them out? Well, here's what we do. Let's start on the far right here. Pension assets starts out at a $12,000 debit. We add to that $3,000 debit. Add to that an $800 debit. But we have to subtract this $2,500 credit. So 12,000 plus 3,000 plus 800 minus 2,500 is 13,300. Coming over to the projected pension liability, we'll go 11,000 plus 4,000 plus 550 minus 2,500 is 13,050. So all we have left is to figure out this $250. There's two ways to do it, and they should be the same either way. I think the easiest way for me is look at pension assets, $13,300 debit, projected pension liability, $13,050. So what we do is we look at which side's bigger. It looks like the debit side's bigger. And how much bigger is it? It's bigger by $250. So the debits are bigger by $250. So we have $250 debit. So the assets are larger than the liabilities. We could also do it vertically too. We start out with a $1,000 debit. We subtract away the $750 credit. That leaves us with $250 debit. So this $250 debit can be found either horizontally or vertically, and it should match. And if it doesn't, that means you did something wrong. So coming down the page here, here's the journal entry, pension expense, $3,750. Where'd we get it? We get it right there out of pension expense. Bingo. Cash. Cash was spent here, $3,000 credit for cash. The pension asset liability, $750 credit. There you go. And on the balance sheet for 2002, the non-current asset. And it's a non-current asset because it's a $250 debit. When you have a debit, that means asset. If it was a credit, that mean liability. So here we go. Pension asset / liability, $250. So that just tells us that the pension fund is a little bit overfunded, which is a good thing. So ladies and gentlemen, I hope you found this helpful. If you did, hit that subscribe button and the like button. That tells me that you are getting some out of these, that you want some more of these videos, that they're helpful. So do that for me, and we'll see you next time. Talk to you later. Bye now.